Hey, good morning. I know it's a bit early. Yeah, it's a bit early, but let's get going. There's no time like right now. Welcome to Forex.Today. The YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning trades in advance. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I like to trade currencies. I like to trade commodities. I like to trade stock indices. Cool. Neat. So ask questions. I've been doing this a long time. I have a lot of education. I have a lot of experience. So I've figured a few things out, and I figured even more things out that are what not to do. Learning what to do is one thing. I learned the hard way what not to do, so I can share all of that. Look, I want you to succeed, so just let me know how I can help. I consider myself a servant in our relationship, so let me know how I can serve you during this hour of power. Besides these live streams, in the description below, you will see a link to free training courses. You will see a link to my book on Amazon.com. You will see a link to FXBootcamp.com. 65 hours of premium Forex trading videos for $88. You can also join live groups there. But the basic membership, $88 a year. Look, I want you to join. It's cheap. You'll be amazed. There's also a link to tradersway.com. You're going to need a broker. I suggest one that is trustworthy and ethical. Traders Way earned my loyalty and respect through their actions many years ago, not through words, not through advertising, but through their actions. And if you go to tradersway.com and open up a demo account, perhaps they can earn your loyalty and respect as well. Johnny says back to 8. No, I got stuff going on today. Busy. I'm a businessman, so I got some beeswax to attend to. That's all. Otherwise, it's still summer season. So, tradersway.com, open up a demo account. Here he is. Okay, so what do you see here? We've had a lot of news lately regarding the dollar. Okay. Aaron, why don't you contact their support? I don't know. Bitcoin? Litecoin? Okay. Anywho, after looking at that news, last night we had an amazing meeting at the FX Bootcamp swing trading group. We got a couple of dozen of the smart minds from all over the world, and we discussed the future, in particular on how to trade it. And so one of my takeaways is, I'm still a dollar bull. And in the short run, it had been going up, which means, in that case, being a bull is a sign that you should, the market not being bearish is a sign that you wait. And on a 15-minute chart, boy, oh boy, does it look sideways, doesn't it, eh? Aye? You know what I mean? Nudge, nudge. Okay. But we have to also look at it in the context of a swing trade. And it's more swing tradable now than it was earlier because it was too early to be swing trading and position trading August. So you have to look at the fundamentals. One of the things we covered last night in the swing trading group is now is irrelevant. Somebody said, well, if you look at GDP now, no, we're not interested in now. We're not interested in what's happening now. We're interested in the next 3 to 6 months. Where will we be at the end of the year when it comes to the Fed funds rate, and how is that changing? What do you expect the economy to be doing? Not now. People have already made those decisions. So what will it be in the future? So, for example, I believe this is institutional money selling euro dollar. This is institutional money exiting their short positions going into a Fed meeting, which is an event risk. And that at some point in the future, they will continue because not a lot has fundamentally changed. I mean, there has been, and we did some deep dive research and looked at some pretty key numbers to show how different opinions, or I should say, how opinions have radically differed and changed over the last month and over the last week. And that's because they're looking 1 year in advance. So anyways, that's what we do at the swing trading group. Besides looking beautiful, we look at smart money behavior. Another thing that I've covered lately in the premium groups at FX Boot Camp and the live groups is the backwardation of the oil market, in particular the spread between futures contracts going out to the end of the year, and the backwardation that it shows. And I use that information to develop a bias. Okay? We don't have opinions, we have biases. Biases are created from the interpretation of facts. Now, I might disagree with your interpretation, which is perfectly fine. But facts is facts. You got to give me the facts, ma'am. Just the facts, ma'am. Okay? So there's no opinion. There's only bias. So my bias is I'm still a bull on the dollar. Cool. Fine. Great. Sure. So we could look at like Piggy. Piggy, can't you see? Sometimes your trades just hypnotize me. Yeah. And I just love your volatility. I know that was hard. All right. What do you think? Something like that? Well, you can't get excited until we break this level and this level, which is kind of the same. Okay? Which means the first to enter, okay, would be those that are going to play the lower high. And then the breach, so somewhere in this lower area, you will likely get like na, that kind of stuff. But it hasn't happened yet, so you got to know, yeah. You got to, treat these charts with respect. I would never sell into a 4-hour 21. That'd be ridiculous. So you got to think ahead. Are you a bull or a bear? Okay. An exact same thing. Okay, exact same thing on this pair. Okay. Exact same thing on this pair. But if you were a bear, okay, bear, which means down, this rolling over here makes total sense. We got to breach the trend, retest the breach, and then move on.com. What do you think? It doesn't say that yet. You have to understand, if you're a pure technician, you're going to be thinking this. And that is correct, by the way. So what I'm saying is if then. If there's a breach of that trend, then the way to enter it is on the retest. Right, Jordan? You're like, no, it's not Jordan. It's Jardine. Okay, Jardine. Is there any more to that? No. It's not rate hike exactly. Okay, it's central banking policy. Okay, so the Fed is raising, Fed interest rate up. Okay, that creates USD up. Okay, but if you look at ECB, their policy has to do with their economic conditions, which have to do with the war in Ukraine, which means what? They're raising interest rates. Really, they should be cutting interest rates, but they're already zero. And it's not because they're raising interest rates, they are. But the economic conditions they're in equal US dollar strength. So is it the Fed or is it the ECB? Yes. What's the difference? Well, the ECB is a central bank and the USD is the reserve currency. And the reserve currency behaves differently than other currencies. Okay? So it's not, it's not necessarily that they're raising interest rates. It's the economic conditions that are projected that make the central banks create a policy and then change a policy. And that's what I'm interested in. I don't care about non-farm payrolls per se. I don't care about consumer price index per se. I don't care about gross domestic product per se. But I analyze these economic data points to try to discern what is the central bank going to do about it. Should they stimulate the economy? Should they cool off the economy? Is the economy neutral? Because we call this a business cycle. And business cycles, on average, on average, grow at 2.2%, right? The U.S. economy, but you're very rarely at potential GDP. So this is GDP, and so sometimes the economy is red, smoking hot, and the Fed has to raise interest rates and cool off the economy. And then we go into a recession, and then things get bad, and the central bank then has to stimulate the economy, and then things get red hot, and they have to cool it off, and then things, right? And then so on and so forth. So you're looking at all this economic data to figure out where you are in relation to potential GDP. Have you peaked and a recession is coming? Or have you hit a trough and the stimulus that the central bank is put into place is starting to work? And then inside that, we have things like, I've taught FX boot campers things like the productivity gap of, okay, where you are here and where we want to be. That's productivity gap. Okay. Then in here, in this zone here, you would have excess money, excess leverage, which the Fed would want to raise interest rates to try to get rid of that dumb money before it creates the inevitable recession. Okay? So that's why I do all this stuff. So I can try to figure out where we are and where we're going to be in the next 6 months. Okay? So therefore, when you get an inverted yield curve, when interest rates are, remember, we were at like 1% and the market's like, oh my God, inverted yield curve, the market's going to crash. No, it's not. Inverted yield curve does create, or can, let's say, inverted yield curve can predict a stock market crash within 6 months, for sure, in the right context. And apparently many analysts and all of the media doesn't understand the difference. Okay? If interest rates are 5%, and then the yield curve inverts, that could, depending on growth. So the last time a yield curve inverted, and it was worth noting, and by the way, I put the biggest trade of my life happened back in 2007, I think it was, when short-term borrowing, I don't remember what the number was, but let's say if you were a small business and you had to borrow money for inventory, like the classic example I give is a shoe store. In the middle of summer, you have to order winter shoes so that they make your products and then ship them to you. So you buy them in like June, and by October, you got them on shelves, but you got to pay for them in June. So you borrow money to order your inventory and it gets made. And let's say your borrowing cost is 6%. Well, that's going to be a problem when your profit margins are 5%. Why are they not 10%? Well, they used to be 10%. Okay? They used to be 10%. But what happened? Your rent went up. Your insurance went up. Okay? Your employee wages went up. Okay? The cost of advertising went up. Even the cost of your inventory that you just ordered, because it's a booming economy. Your shipping costs went up because of fuel costs went up. You understand? So, but the price of shoes stayed about the same. And this is what the yield curve is trying to tell you when it inverts. This went so high because all of this is happening, and it takes down the profit margin. It used to be 10%. Now it's 5%. And the problem is, at some point, what matters is that you're paying attention to all of this. You're reading the tea leaves properly, and all of a sudden, it's -1. Short-term loans cost a small business 6%, and all of this other stuff keeps going up. And now they're selling shoes like crazy. Okay? We were talking about the economy and how it affects people differently. Not only has Dom Perignon sales gone up, remember? Inflation only hurts poor people. That's why I don't recommend poverty. Sales of Dom Perignon, $250 bottles of champagne, are up 15%. And you may have learned today that $1,000 iPhone sales are up 3%. Apple just makes less money because of all this other stuff. So this is happening. And what you want to look at is when companies start to report that sales are up, but profits are down. So Apple sold 3% more iPhones this quarter than the previous quarter, but they made less money. So this is happening. But a year ago, 2 years ago, people were freaking out about an inverted yield curve when it was basically flat. It was technically inverted, but you got to put it in the right context. Okay? Remember, journalists learn how to write good, but they don't understand money none. Okay? So they read in a book somewhere that an inverted yield curve means recession, and then it starts to be reported. And I laughed at that. Yeah. We're not quite there yet. Okay. Not quite there yet. Let's take a look at how the markets are moving. You are not alone. I am here with you. Okay, S&P 500. Ooh la la. Do you know why it's going up? Because on the way down, okay, I bought. Okay, I bought here, I bought here, I bought here, I bought here. And then here I hedged, which means I actually sold, right? And so because I hedged, it's going up. So I'm losing money on the hedge. That's how the market works. Whatever Wayne do, punish him. But anyway, so this was good though, because I own all this, of course. Buy. I saved money for more than 6 months to start buying as the stock market falls starting in January. Can anybody confirm that? I don't know if we have a big enough audience because I started at a weird time. But is there anybody here that clearly knew that I did that? That I saved as the stock market's going up? I saved and I saved and I saved. Oh, it's going to come down. It's going to come down a minimum. I said 10 to 20%. 10 to 20%. That's not a small, prediction. And then I said I was going to buy on the way down, which I did. Now I don't know the bottom, so I bought, I think it was basically the third week of January, third week of February, third week of March. Somewhere I think around May, I was fully deployed. Right? Somewhere around May or June. I can't remember. I had spent all the money. I invested everything that I had saved. I'm in positions. I had a couple of more. And then once we got to about this area, I hedged because this might be something that happens in the future. And I need to protect all this up that I have. Okay, so short, let's say short for 5 months. Okay, long for 5 to 15 years. Okay, neato, right? Neato. So anyway, so my hedge is losing, but it's not 100% hedge. It's just a help if the market goes down. And on the way up, it's just insurance. If you own a home, you probably have insurance on your house. It's a hedge. Well, what if it burns down? Insurance. What if there's a flood? Insurance. What if you have termites? You probably have separate insurance for that. What is that? You're hedging. 99% chance you're going to lose money on your insurance policy. But yet, we've been, hooked into that nonsense? What a scam that is, huh? Health insurance makes sense. You're going to get sick and die, guaranteed. But there's no guarantee your house is going to burn down. So anywho, that's the S&P 500. It's pretty, huh? Pretty awesome. So we've been having some up days. Up days is the best days. Now I drink champagne when I'm thirsty. Man, you just got to, right? Ruble. Anywho. You can get this plug-in here. It's called Floating Player. Watch this. So this is on a web page. Right? There's a Trader's Way homepage. Okay. But it's an actual browser, right? You got the tab, you got the search bar, you got the bottom part, and you're like, it's okay. But you use this little thing and you pop it out. Isn't that pretty? Now there's no browser. Now it's just a platform. Now we're back in business, man. Isn't that pretty? Isn't that lovely? Isn't that lovely? Yeah, that's what I'm saying, right? Hope life insurance is a good hedge. Now, the right type of insurance policy is interesting. So we've covered over the years of me doing live streams. There's a big difference between being poor and being rich, and the whole world changes when suddenly you got money. Okay, I was told many years ago by my accountant and my tax attorney. He said, Wayne, there's two taxation systems in the United States. One for poor people and the other one for businesses. Okay? Poor people earn income or like a wage. And rich people, they own assets that produce income and asset appreciation, and it's taxed way differently. There's a difference between earning a paycheck and having a distribution. Okay? All that kind of stuff. And when you get to insurance, wealthy people can use insurance policies in crazy ways, and I don't even understand it. I'm not an insurance guy. But once in a while, I'll come across a conversation. Some guy is talking. He's like, yeah, so I got this policy and I did this and I did that and I took out $2 million and this, that, and the other thing. And I'm like, whoa, what? Because it's considered an asset. It's basically a personal bond, like you just wrote a bond, a 30-year bond on your life, and then you could use that as an asset and you could leverage and borrow against it and all this kind of stuff. And I'm like, holy schnicker. And then I'm sitting in my media room watching TV at night and actual TV. I do it for my wife's like, what are you watching TV for? Anyways, I'm watching TV and there's all this stuff about for just $1 a day, I can get insurance. I don't need any medical tests. And when I die, I'll have enough money to put a coffin in the ground. And that kind of stuff, that's the poor people stuff. And there's likely no value to that at all. That is probably, at some level, a scam. Hey, it's only $1 a day. You don't even need to go to a doctor. We'll give you insurance. It'll be worthless when you die, and you can try suing us, but we know you don't have any money, so good luck with that. Right? That was a movie, though, wasn't it? A Grisham book? Wasn't it a Grisham book? Anywho, yeah, insurance is really kind of interesting. If I had time, I think I'd probably want to go through that. The client, that sounds right, yeah. And Hope says, yeah, what if you die, right? Well, you will die. And it's scary. So my neighbor got in a car accident just the other day. He's a fancy pants dentist. And yeah, it looks bad. I don't know what happened. I haven't talked to him. It doesn't look like anyone would have actually died in there, although the driver's side window is smashed. So I'm like, well, that was his head. Okay. Oh, I don't want a license in Georgia. No, what I was thinking, I got sidetracked in my own thought process because I was going to recommend, I was going to say, I would recommend to somebody that they take the Certified Financial Planner course, the CFP. Not the CFA, the CFP. And you learn things, you become an expert in basic things like wealth, stuff that goes into wealth management. But including in your wealth management, not just your stock and bond portfolio and your real estate portfolio and your retirement portfolio and your risk asset portfolio and all these other portfolios, but also your insurance portfolio. They teach you about insurance. And I thought, you know what, that is smart. The reason I got sidetracked in my own brain is I'm like, oh yeah, I wanted to ensure my children take that course. Because I think everybody should know that kind of stuff. That's the stuff your dad was supposed to teach you, right? Son, sit down. Sit down next to me. Let's go. Let me teach you about insurance. Oh, that's awesome, Dad. I've always wanted to learn about insurance. Huh? My papa told me when I was young, sit beside me, my only son. I wonder, you should be an insurance man. Sell policies to poor people if you can. Yeah, anywho. Yeah. Anything for a commission, son. Get her done. Yeah, but CFP, yeah. Oh, yeah, the Series 6, yeah. Yeah, okay, yeah. But a CFP, honestly, that should be something I think that really is taught in to seniors in high school. Okay, stop teaching Shakespeare. In sooth, I know not why I am so sad. Okay, that's nonsense. We only teach it because we teach it now because the teachers were taught it, and they were taught because their teachers were taught it. We only teach it because we've been teaching it for 300, 400, 500, 600 years. Dude, who cares? Most people in America don't need to learn Shakespeare. And if you look at the kids, when they're reading an iambic pentameter, talk about glazed over. They're like, this is stupid, right? So what should they be learning in 12th grade? About managing a budget, saving for the future, paying rent and mortgages. How do mortgages work? But things like insurance. They should take the CFP. Okay. But Jeep says, okay, hey, what is the future of the yen in light of the 10-year bond that I pointed out yesterday? Well, what I told you is you need to watch that. Did you go to the Bank of Japan website and read the many, many press releases on yield curve control and qualitative and quantitative easing? 0.33, 32, 35, 40. So that will dictate, that will determine. So the answer is, what is the future of the yen? Anything the Bank of Japan wants is what the future will be. Okay? I could tell you about seasonality right now. Okay? And it would be wrong. Because what's happening now is not normal. Over the last 50 years, this time of year would be different than the last 20 years. Okay? Although, okay, this is normal. This is abnormal. So, okay, over the last many years, I look to start selling selling pairs, Japanese yen pairs, around this time. which means I'm buying Japanese yen, right? Okay. Usually, starting around this period of this circle, I'm selling this pair. And CAD yen and Aussie yen. Okay? And so far, pretty much anything, not USD yen, not Swissy yen, but I'm simply cornering the market on the Japanese yen. I don't really care about what other currencies unless they're funding currencies. And I don't trade funding currencies versus funding currencies. But anything with the yen, because I'm buying yen across the board. The order has to do with relative strength. You know, which one do I buy first, second, third, fourth, so on and so forth. That has to do with relative strength. That doesn't take me long to figure out, but I'm cornering the market. This year, it went way, way up for 3 weeks straight. That's very unusual. So, what I would look at, Majib, is what happened. Okay? What happened? Also, this is the right direction. I have no problem with that. Okay? I would expect up to happen. And like I said, around here, I would expect down to happen. That's what I call bias. And that comes from seasonality. The study of historical, the study of timing of historical trends. But the velocity is redonkulous. So you want to look at this and see if you can find helpful information on the Bank of Japan website. Now, maybe you're capable, maybe you're not capable, but you could do your best and try to ask yourself questions. Well, what started to happen around here? And you, like, for example, if I were me and I said, well, something radical happened somewhere between the beginning and end of February. So I would say really somewhere really the middle of February to the beginning of March, something happened. So I would go to the part of the BOJ website that has their press releases. And go to look at all press releases between February 15th and March 15th and see if there was anything unusual. Monday says, I think when I scale down to lower time frames, I lose perspective and enter too early. Cool, that can be fixed. You just don't know how to trade very well. But that can be fixed. That's just, you probably need to learn better techniques and have a more guided experience. Right? Like everybody has that problem in the beginning Monday. It's like going to a golf coach and say, hey, you know, I can hit the ball pretty well, but I seem to slice a lot. That's 90% of everybody's problem. You're like, I've spent over $500 buying different drivers. And I bought different shoes. And I have $300 golf gloves. Guaranteed to make me hit straight according to Sir Nick Faldo. And then the golf pro is like, okay, here's another rich idiot that I have to coach. So he's like, okay, go out and hit a couple of balls, right? And let's just see your swing. And then the the golfer walks over, sets up a ball in a tee, squares up, and then the coach is like, whoa, dude, whoa. And he's like, what? I haven't even hit the ball yet. You're like, oh my God. Where are you aiming? You're aiming way left. He's like, yeah, well, I always hit it right, so I have to aim left so the ball might land in the fairway. Like, oh my God, dude, just aim straight. Well, then I'm going to slice it. Okay, whatever, just aim straight. Okay, so you get the guy to aim straight. The guy's never aimed straight in his life. So you got to put a little tool on the ground, put your feet against this, square up to the ball properly. Okay, great. All right, now hit a ball. So the guy squares up weird, and then he pulls the club back. Whoa, stop, dude, stop. And he's like, what? I haven't hit the ball yet. Wait. Where, like literally, wait. Where's your weight? You're leaning on your back foot. And your club is like crazy open, and you haven't even finished the backswing yet. So, look, let's do something here. You got to lean on your left foot, but don't lean your head left. Keep straight, but just shift your weight on your hips a bit to the left. And now, your club, let's address that. This elbow's got to go here. Your wrist has got to do that. You got to close that. And all of a sudden, the guy hasn't even swung the ball yet. And he thinks he's pretty good at golf. He's just got a little bit of a slicing problem. Right? You see? And all of a sudden you got to break this down. And like, you're not standing right. You're not aiming right. You're not holding the club properly. This is why you slice. But the interesting thing is that's what golf professionals and golf coaches do. There's probably 1 million golf coaches teaching 20 million people how to not slice. So it's not like you need to figure it out on your own. Okay? So does FX Bootcamp fix that? Yeah, probably. Ask people here. Half the people listening are boot campers. It's what we work on. Tiger Woods works on not slicing. Okay? The top 5 golfers in the world, for now, are not slicing. But they'll get old, they'll get injured, they'll get a sore knee, they'll get a sore back, and then they'll start slicing again, and then they won't be the world's greatest golfer. So you're the world's greatest golfer when you can do it right for a while. The thing is, you can maintain your skill because it just doesn't require your physical ability. Okay? You can sit on a beach and trade. I love sitting by the pool trading. One of the best trades I ever made in my life was on my honeymoon in 1842. And there I am in Kapalua, Hawaii, sitting by the pool. I have a cellular telephone. A cellular telephone. And I was like one of the first people that had the ability to trade off my phone. It was cool. Like, it was neat. Like, wow, I could trade off my phone. So my wife is off somewhere getting a drink or somewhere, and I'm sitting by the pool. I'm like, what am I going to do? Oh, let's make some money. Pulled out my cellular telephone, and you didn't. It was just a tiny little screen, and I placed a trade, and I paid for the whole day. the hotel, right? A suite at the Ritz-Carlton, dinner, drinks, and snorkeling while I sat by the pool. And I'm telling you, one of the greatest trades of my life. Right? And so that's how, just meaning I never felt so good. It was so good. I'm like, I can't freaking believe it. It's so awesome. I just made a trade by the pool and I just made money. Oh, it was just like incredible. Right? And so we're not like professional athletes that way. Athletes have to be trained and coached. They have to practice, focus. They have to have a killer strong mind and psyche and right? All that kind of stuff to stay in peak performance. But an athlete can't do it for very long. You can do this the rest of your life because you can sit in your backyard and make money. You can sit on the beach and make money. You can sit by the pool and make money. Okay? I've made money sitting at the top. I think I was on like the 130th floor in a conference room doing a live stream on YouTube. Looking down on Hong Kong. Very cool. But the thing is, you must maintain that competitiveness of an athlete. Sound body, sound mind, constantly training, constantly practicing, constantly being coached. If you're not coachable, I'm not sure if you could make it on your own. You're like, oh, but I'm a freaking genius. I can figure it out. I'm special. Look, we all think we're special and let 95% of us lose. Well, but I'm above average. Everybody here thinks they're above average. What's the problem with that? We're all above average. Right? So it's part of how difficult this is. You got to stay A game for years, but you can do it. But you might find yourself working on weekends, reading newspapers. Maybe you've printed out central bank reports, OPEC reports, government reports. You're looking at EIA charts on the weekend. You might get up very early to scalp oil. You might stay up late to trade Asia. Huh? You remember Bud Fox being woken up early in the morning? And Gordon Gekko is on the beach and he's like, I just made $2 million trading gold out of Shanghai. I'll give the money to you. Play with it. Impress me. Well, do you want to be the Bud Fox or do you want to be the Gordon Gekko that made $2 million trading gold out of Shanghai? Like, hey man, that's what it takes. Right? I love trading Asia. Money never sleeps, pal. Thanks, Hope. That was perfect. Okay. That was perfect. So anyways, I want you to think about that. You can do this the rest of your life. It just never gets easy. Okay? So you better love it. I love it. Okay? I love it. I think things could get very good. I think things can get bigger than your dreams. I trade Asia every single day, 7 p.m. Eastern time with my day trading group. but I'm usually already at my charts around 5 or 6. Then at 7, we spend about 45 minutes to an hour analyzing the markets and the news and all that kind of stuff. And then very often after that, now it's about 8 or so, I'll trade from 8 to maybe 11, sometimes 12. But by then, I'm usually 3/4 of a way into a Cabernet Sauvignon blend. Papa gets sleepy. Papa, don't sleep. I'm in Euro deep. Papa, don't sleep. I'm in Euro deep. But I'm keeping my dollar. I'm gonna keep my dollar. Ooh, oh. Huh? So that's how that usually goes down. And then you got to wake up early, and I grab my phone and look at the markets right off the bat. Okay. And so like one of the things we're going to start doing probably at the end of August, early September is every day at 7 o'clock in the morning. Okay. So now I'm up to, let's say, midnight, get some sleep, wake up, shit, shower, shave, get to the charts, and the oil trading group will start scalping oil at 7 o'clock in the morning. Then I got my morning routine. Then I got to get ready for the 8:30 news. We meet here at 9 to get ready for the stock market opening. Okay, market opens are the time to trade, so on and so forth. Money is the core of life, which Victor says. Yes and no, I'll agree with that. My rationale isn't about money, but it's the measure of the success or failure of the game. It's a unit of account, is the way I look at it. So I think the idea of, getting rich quick, the big money, that kind of dream, that's very amateur. It's very early, it's very young, it's very youthful. Okay? Right? The idea of a yellow Lamborghini, and girls in bikinis, right? It's all a young male, silly little amateur dream. But later on, when the boy becomes a man, or women are always on the right level. But boys become men, and then you realize you still want all that crap, but now you got to take care of your family and your children and your neighbors, and you got to take responsibility for things, and your parents get old and you got to take care of them, and all of a sudden it's all about responsibility. So the whole, like, the dream, the money dream stuff is just, it's really young and youthful. But later on, though, what you will appreciate, the richness of being a currency trader is the life. That's the greatest value. Money is the unit of account for measuring whether you were successful on the trade, or you were successful today, you were successful this month, you were successful this quarter. But what will happen is a lot of this stuff, the money, if you learn how to trade properly, is dictated by the market, not you. You can have great years and it's just raining money, but you're not a genius. It's just the market conditions. Quantitative easing does that. And in other situations, you're not as successful, but it's not that you're a bad trader or you made a bunch of mistakes. The market, right, which we call the beta, didn't perform. It was a tight market. It was a slow year. Your returns will be decided by the beta. Now, your alpha is your ability to beat the beta. So let's say the stock market only goes up 3% in a year. It's a big sideways year. Your alpha is your ability to beat that benchmark, but people would be wary if nothing happened all year and you're up 100%, they're going to look at it and very quickly realize the only way you made money was by taking on risk. You gambled. Okay, you threw giant trades that moved a little bit and you got a huge return. Nobody wants that crap. Once again, that's the amateur boy trying to get rich quick. But the problem is now you're doing it with other people's money and you will not survive, and you'll never have that Lambo unless you lease it. And if you do that, that means you're not on a path to ever deserve it anyways. So it's silly. Okay? So money is a consequence of doing things right over long periods of time. There's no other way. Compound interest. You must create more value than you charge, and then do that over long periods of time. So even if you work at a company, okay? If you work at a company, you're an employee. The business needs to earn 3 times more money to pay for you because there's costs to having you. Whether you're a cost center, so let's say you're administrative, or you're a revenue source, so maybe you're in sales and marketing and all that kind of stuff, somewhere in between. It doesn't matter. The way that the company should work is no more than 33% of cost should be employees. So the way to look at that is when you get hired by a company, let's say they pay you $100,000 a year. If you don't produce $300,000 in value, you're not worth it. In fact, if that's a chronic problem, the company will go out of business because the people are not productive enough. So you should look at that as the secret to life. Not monetarily, but you should add more to the universe than you consume. Otherwise, you're a parasite. Okay, you're living off the charity and productivity and the kindness of others. Okay? And so you can measure your value any way you want. The thing is, you got to wake up in the morning and be valuable. Make the universe better. Make society better. Make your neighborhood better. Make your family better by providing. Maybe that includes insurance. But that's the key. More value than you consume. So if you're a small business, the secret is simply whatever your business does, provide a lot of value. And if you can charge less than the value, you will have customers that are happy. And that will include running your successful Forex trading business. They don't want the degenerate gambling child. That's a fool's fallacy. Okay? So instead, provide consistent returns with low volatility over very long periods of time. In the beginning, you're going to say, well, Wayne, that doesn't make a lot of money. Well, that's the interesting thing, isn't it? You're producing low volatility, consistent returns. You're doing it with low risk, and it doesn't pay you much money. Well, it's the monetary unit of account that is probably your problem. You're doing all the right things. You're creating value. without taking risk. The value is much higher than the risk, and it leads to consistency. But then you're like, but Wayne, I can only, if I'm taking out 20% and leaving 80% in the fund, it's only $1,000. I can't live on $1,000. So I have to jack up my lot size. No, you just ended your career if you do that. Because once again, you're focused on the short term. If it only pays $1,000, leave the $1,000 in, get a second job. The thing is, what you really should do is show what you're doing, the value creation of your small foreign exchange business, the amount of value you're creating. Remember, that's returns over risk will be value. And increase your assets under management. Because there are lots of people on this planet that are searching for you. Neo, you are the one. I've been looking for you, Neo. They're looking for you. You understand? They're searching. Money, as we said earlier, never sleeps. It's searching for you. I want you to think about that. It will take you some time, but money is searching for you. So stay small in the I say it every day. Stay small, stay humble, focus on the long term. If you can show that with a track record, you never risk, you never gamble, you don't play with the numbers, you don't play with the lot sizes to cheat to show that you're getting a higher return. Okay? That's what everybody else does. And it doesn't work. So instead, stay small, stay humble, focus on the long term. And then go out and speak to more sophisticated people that would want to be a part of that. And then do that for a few years. And then more sophisticated, wealthier people who your first clients probably know. And then they make some introductions and they invest. And then you do that for a few years. And then those rich people, so you brought in rich people, and then the rich people brought in richer people, and then the richer people bring in much richer people. Because everybody likes to brag, in particular to richer, more powerful, more successful people. So you find yourself at a party with people you look up to and admire, and they're like, hey, what's going on? You're like, well, I got this Forex guy and he's crushing it. It's so awesome. You should really take a look at this. Oh, really? Yo, he's the best. It's amazing. I've been with him a couple of years, right? We got the liquidity and we got the income attached to it. But the thing is, this guy's a money machine. Never gambles. Just very consistently produces a return with very little volatility compared to all this other stuff in the world. This guy's like a light, a guiding light in a world of darkness. You got to get in on this. And the rich guy then says, yeah, I should do that. And you just keep doing this the rest of your life. Because we're service providers. You're like, well, that sounds terrible, Wayne. I have to work hard the rest of my life. Yeah, it's like becoming a landscaper. You better like cutting grass because you're going to do that every day. But that's what you get paid for. So love it. So what do you do every day? You just trade. It doesn't matter in Forex. In other markets like stock markets, it does matter. But whether you're trading $10,000 or $100 million, nothing changes on your end, except the lot size. But the lot size is a percentage of assets under management. So lot size is a function of AUM. So Your AUM goes up by 10%, the lot size goes up by 10%. Or what I recommend in my book, if it goes up 10%, maybe lot size only goes up 5% and you take even less risk. But the thing is, what you do every day doesn't change. The only thing that changes is the assets under management. You can't control the market. The market dictates your return. So whether you make 5% this year or 50% this year, that is relative to how the year was, not to how much gambling you did. So the market is going to have good years and bad years, but you can roll through it because you're consistent and you never gamble. You never put yourself in trouble. You know when to get in, you know when to get out. It's just all la-di-da-di-da. But you're consistent through years that are good, bad, sideways, good, bad, sideways, good, bad. And other markets, other investment opportunities have great years and then they crash and all that kind of stuff. And meanwhile, you're just very consistent. People will find you because that's what they're looking for. And so you'll have good years when the market's good. You'll have mediocre years when the market's mediocre. You'll make money when the market comes down because you can do that. You're buying yen and dollar instead of selling yen and dollar. It's not a big deal. It's a big deal for other investors, but for you, it's fine. And you're scalable and all this kind of stuff. It's what they want. So you have the good years, bad years, whatever. It's just day after day, month after month, quarter after quarter. You're just doing your thing, but your AUM keeps going up and the amount of money you make keeps going up. The risk doesn't go up. In fact, if you're doing it right, the risk goes down because after a while, you have enough AUM where you're living well enough that you don't need like another 10% income. Wouldn't improve your life at all. You're like, whether you made 1.1 million or 1 million doesn't make a damn difference, does it? You're like, dude, $1 million is enough. Cool. So you can actually lower your risk even further and be even more consistent. And just say, well, I'll lower the risk by 10%. I'll only clear $1 million. But it's cool. Like, I will survive. Huh? You see? Because you're like, yeah, I'll just lower the risk a little bit more. It'll be fine. It'll help my consistency. My Sharpe ratio will be fine. And the funny thing is, here's the real thing there's so many paradoxes in Forex. And this is another paradox. The bigger the money you're raising, let's say you go from talking to doctors and lawyers, hey, can you throw in $100K? What if you were talking to somebody that had $1 billion? They want you to take less risk. The bigger the money, when you go from $10,000 investors, $100,000 investors, $500,000 investors, $1 million investors, $10 million investors, $50 million investors, $100 million investors, okay, up to $1 billion and more. As you go up that value ladder, they want you to take less and less risk. It's a paradox. Poor people want you to gamble. Hey, if I gave you $10,000, can you double it every quarter? I've been asked that a million times, but even with bigger money than that. But of course I said no. But the bigger the money, the less risk they want you to take. They don't want 80% a year, they want 8% a year. And then they feel bad. They're like, but you're not going to make a lot of money because I can only give you 100 million. So I'll pay a higher management fee to make sure that your costs are covered and you don't need to gamble with my 100M. So I'll guarantee you $3 million a year from the 100M and just try to produce, 12 12% if you can. So that after all the other expenses, your performance, for example, after that, we still have our 8 to 10%. So like, we'll guarantee you $2 million a year. And if you do this right, there'll probably be another 2 at the end. But please, please don't gamble it. Please don't take risks. We'll pay you to ensure you don't. It's that important. How many people would take that deal? $2 million a year guaranteed with $2 million bonus at the end of the year likely, as long as you don't gamble. And so you're taking ridiculously small lot sizes. Ridiculously small for the money, because you're only trying to do what? 1% a month? 1? But of course, like I said in the beginning of this topic, if you only got 10 grand, that doesn't make any sense. You're like, it's not big enough. Well, that's why I want you to be able to create value. I want you to focus on your valuation. Are you worth that kind of money? Somebody will need to look at you and say, I'm going to pay this guy $4 million a year. But if he does it, it's $8 million to me. You didn't create $4 million in value. That's you. You created $12 million in value and charged $4 million for it. Do you think you could do it? Do you think you could sell that? Do you think someone is willing to pay $4 million to receive $12 million? They're not going to believe you, so they're like, well, have you done it before? Let's take a look at your track record. And you're like, I've been doing this for 15 years. Never got into trouble because I'm not a degenerate gambler. I'm very consistent. I'm low volatility, consistent returns, even though the markets change radically year by year by year. Good year, bad year, horrible year, awesome year, horrible year. Fed moving things up, Fed moving things down. Crisis number 1, crisis number 2. Doesn't matter to me because I take so little risk. That's the sales pitch, guys. Can you produce more value than you consume? It's the secret to life. Do you make the world a better place? Can you make somebody happy? Can you feed somebody? Can you take care of somebody? That's all we do is take care of people's money, but what do they do with their money? Take care of the people around them, whether it's their company, it's their retirement, it's their elderly parents, it's their young children, it's your future you're taking care of. But if you want to drive a fancy car, have a fancy watch, and have a giant TV on your wall so you can play PlayStation for hours on end, yeah, no value. So have a wonderful weekend. Please fall in love with being a currency trader. I think you're going to need it. This will be hard and difficult and require a lot of energy from you for the rest of your life. The last thought as you fade into the good night will be, shit, I didn't close my trades. But they were all winners, baby. They were all winners. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend. If you're in my day trading group, I will see you Sunday night so we can get our trades on for the week. How awesome's that? Take care, everyone.